Peter Rose, Longwood Currency Trading. Good morning. Got my coffee. It's a beautiful summer day. It's the going on the end of June of 2022. Squeezing the FOREX rock for more money. How do you take a trade and get the most amount of profit out of it that you can? Well, there are two ways, and you can combine them. The first way is to simply manage that trade beyond the initial profit target that you had and just let that run until it ain't got nowhere else to run. You make more money than your intended profit target. And the other way is to stage in more lots as the trade moves in your favor. Now, I'm not a real big fan of letting the price move beyond the profit target as the main methodology that I would use. And the reason for that is when you set your profit target, I mean, you're at some starting point. If you're a day trader, that finishing point is a couple hours away from you, or maybe the trade will have to run it through the day or whatever. In my case, I don't want to sit there for 2 hours. Or I mean, for all day, I just want to sit there for a couple hours and make my trade. Today, for example, I got up. The trades. I had a trade that was running. I had some other staging into the position to do, and I went down to my desk. Again, the trade is moving in my favor. I staged in another lot, and then I figured, well, maybe I could squeeze another one. It looks like having enough momentum there. It actually is the largest trade that position that I've put on. I'm trading 20 full lots at this point, and within about 15 minutes, 20 minutes of me actually opening the trading platform up for the day and taking a look and seeing what's going on to the fruition, and the end point of that trade was about 20 minutes, and it was a $5,500 gain. So. And the original profit target was $900 on 6 lots. So things change. How do you get more profit? How do you squeeze that rock? How do you do that? One of the most difficult things is to have that price moving beyond the profit target, because as I was trying to mention before, we set that profit target up when we envision the trade, when we do our trade entry analysis, right? And we say, well, this is a good profit target. Well, what does that mean? Oh, well, just 20 pips, that looks pretty good for the day, or 5 pips, or whatever it is. No. There's some structural considerations. There's price action, there's volatility, there's momentum involved, there's maybe some past stuff that's gone on. You take all these things into consideration. I mean, I have 80 pages of one of my course books, 120 pages of first course book, deals with trade entry analysis. And so it's a very simple thing to do. And though there are quite a few things that you need to check and be aware of, it's like getting into your car. When you first get into your car and you're learning how to drive, you got to make sure that the brake is off and there's enough gas, and all this stuff goes through your head. But once you've got 6 months of experience, you just get in the car and turn the key on, and you scan everything, and you're off. Can't do that in an airplane. It's too much at stake here. Too many things that could go wrong. But from a relative speaking standpoint, they do the same thing. They have a written list of stuff that they go through. And so you do that trade entry, you go through that analysis, and you determine that the highest probability of price getting to this point, that's the optimum. And then you back that up a little bit based on your experience, and you say, this is a good profit target. This is an achievable profit target. And so when your price actually gets to that profit target, how willing are you to let that go forward? Because every time the price kicks back at you, that's a loss. Because invariably, when it gets to the profit target, and if you've done your entry analysis correctly, that is going to be a stick point. Price is going to vibrate there or stop, or there's some reason. Maybe the point that you picked as the optimum profit target, there's a high concentration of order flow, and that's manifest by a lot of touch points in the resistance zone that you have identified as where your price is going to be moving toward. And so the expectation is that price is going to run into some issues right after it gets to the profit target. So you go, let's say the profit target is 20 pips, and you get to 20 pips. And then it goes to 22 pips, and then it comes back to 18 pips, and you go, oh, I've lost 2 pips. Or I've lost 4, 8. It's emotionally very difficult for you to do that. Now look how much simpler it would be as price moves in your favor. You start with, one mini lot, and then it maybe 10 pips toward that 20 pip profit target. You add a second mini lot, and then it moves 5 pips more, and you add a third a lot, and then it gets pretty close to the profit target, but it looks like it's staggering a little bit, and you go and cut it. Now you've pushed it, but you haven't pushed it emotionally. You've added to the position such that wherever that price is, you're making as much money with the additional lots that you've added as you would have if you'd have gone for your single lot to that profit target. So from a psychological standpoint, it's a lot more effective in your ability to cope with it and the issues of the trade in motion in real time. And at the same time, you're balancing you're mitigating your risk by the correct type of staging that you're doing. The correct type is by being aware of where your average price is, so that you're not adding a lot and it brings the average price to 3 pips within to where you just added that lot. You're just killing yourself. I mean, you're not going to win. I've long said that the only time you should be losing is at trade entry. If you get the trade entry wrong, it goes to your stop and you're out. That's the only point that you lose, because once the price goes into profit and it moves in your favor, and you're now into a position management stage, you can protect some profit, even if it's only 1 pip, by changing your stop, right? And so you should never lose. The only way that you're going to lose in a position that has moved into profit and you have protected that with a limit stop is if you stage in the wrong way. And that's why I don't recommend staging for beginning traders or traders with less than about 300 trades or a couple of years of trading or a year of trading experience in a live account, because it's complicated and you can really have your roids flare out when you have this profitable position and you've staged into it and you really don't know what you're doing, and you end up losing money. You're going to build some bad habits as to how to deal with that. I've done extensive computer simulation analysis in staging out as well as staging in. Actually, I'm still working on that program. Those of you who have been with me for a while know that I've been working on this staging in simulation analysis program for quite a while. It's not that big of a deal. It's just that I got other things I want to do. And I've recently, dramatically increased not only my bank size, but also the number of lots that I'm trading, and I'm getting into staging and all kinds of things, and I'm working risk management at an advanced level, which is different than how you would work it at a as a 1 lot, 2 lot, 4-figure, 5-figure trader would manage that risk. It isn't that you do it differently, it's that you think of it differently, and it's when you do it that's the difference. That's really the difference in whether you're doing I don't know, not beginning, but intermediate, low 5-figure risk management, as opposed to when you're trading in the 6-figure category. And so it's just, you just do it when you do it is different. That's all. I mean, if you learn everything the right way, if you don't learn it in a process-oriented manner, then all this stuff gets juxtaposed around, and if you do something at the wrong time, you're screwed. And the problem is that you won't recognize that as being done at the wrong time. You'll go, well, that must be wrong because I keep losing, right? And it isn't that what you might be doing is wrong, it's you're doing it at the wrong time. So if you don't have somebody to point out these timing differentials to you, then it's going to be very difficult for you to figure that out, on your own. I mean, my third book in my course series, it's about, they're all the course book sizes are 100 pages or so, 120 pages. That whole third course is on this component of when. That's how important it is. What do you do? How do you do it? And when do you do it? And so squeezing the FOREX rock is a function of when, not so much of how. And so when you get to the point where you're trading multiple lots, whether it's multiple minis or, if you're still trading a mini account, then you really shouldn't be staging, compounding, and doing all this other stuff, because you'll be using those things to make your account grow instead of making more money from the trade. Those are two different things. And you wouldn't understand that until you get into the 5-figure accounts and start trading them as to what that differential is. Regardless of that, if you are a beginner or if you're an experienced trader but you're still trading mini lots, you still shouldn't be staging or compounding or any of that. That's my opinion, okay? You won't find anybody else out there that feels that way. I see guys out there teaching raw beginners and advising them to stage in and stage out of their positions and compound and do all this stuff. And I just think it's more complex that way than it needs to be. And if you don't have the immediate success that you're seeing the other person have, your attitude toward those things becomes fearful, right? And you don't want to be fearful when you trade. You don't want to hope that everything is going to work out. You want to know that everything is going to work out. And so one of the topics that I'm working on in the fourth course book that's in my series, I'm up about 85 pages on that, just finishing that up, is talking about this, the risk management and the risk acceptance and how you think about squeezing that FOREX rock to get the most profit out of the trade that you can. And the misconception is that you get more profit out of it by having the price run further. And that's not necessarily the case. Actually, by staging, you make the profit target move toward you. But that's another issue. It's kind of there's a mathematical analysis that needs to go with that. So how do you squeeze if you're in that 4-figure to 5-figure, low 5-figure, mid 5-figure account size? How do you squeeze that? How do you squeeze that FOREX rock to make more money, to help your account grow larger and feel good about your trading? My best advice to you is become a master of trade entry analysis. Look, if you can get your trade to move into profit so that you can lock 2 pips of profit, you're going to be a winner. You're going to feel so much better about yourself. And you're going to say, well, how am I going to make any money by just making 2 pips when I got a 20 pip profit target that I realistically expect to get 10 pips out of as a day trader? How do I make any money at 2 pips? 3 pips, how do I make any money? Let me tell you, 3 pips on a $1,000 account is 0.3% on your money. If you could do that every day, 3 pips, you'd be making 15 pips a week. Let's say you made 10 pips a week. That's 40 pips a month. $40 on $1,000. You do that for 10 months. You're doing better than a lot of investments that are out there on 3 pips 3 times a week. But the key is to squeeze that FOREX rock isn't getting more pips. It's getting a small number of pips a consistent amount of time. That's where the confusion and the problem is for those of you that are beginner traders and haven't quite got up into the mid to high 5 figures yet to see the impact that small pip value has. I mean, oh my God, what are you going to do if you get 5 pips a day and you do that 4 days a week? 4 days a week, 5 pips, 4 days a week, that's 20 pips, that's $20. That's a pizza. I mean, how are you going to feel? You have to really manage your expectations correctly, but you're a winner. You're squeezing that FOREX rock for everything it's worth. If you're getting 10 or 15 pips a week, God, you're doing great. Think of what that would translate. Let's take that. Let's take that 3 pips a day. Average. Some days you're going to make 10, some days you're going to lose 10, some days you're going to make 8. When you average out to 3, so that over the course of the week you get 3 times 5. You get 15 pips. So that's $15 there, $30 in 2 weeks, $60 in a month, or 60 pips in a month. Let's call it 50, just for the sake of argument. 50 pips a month. On a $1,000 account, that's $50. On a $10,000 account, it's $500. If you could do that, right? And a $100,000 account is $5,000 a month. Now, I just closed this trade today. It's run for 5 days. But I didn't load the majority of it. I started at 3 lots. That's what this trade started at 3 lots, and it ended up I'm trading 20. The bulk of that came within the last few days, and so effectively I've held the trade for 5 days, but the bulk of it has been 3, and I made $5,500. So when you trade with size, you make an incredible amount of money with the same number of pips. And so squeezing the FOREX rock is a little different depending on where you are in your FOREX journey. If you're where I am, trading multiple lots, then squeezing that FOREX rock is a process of simply staging in managing the profit target as a function of the momentum of current price as it's moved forward. As you stage through on some of these positions and you have confidence in the positions, you don't have any problem moving that profit target out because you're right there watching it. And if it doesn't look like it's going to get to that profit target, you just kill it where it is. I mean, you have to have that confidence. Oh, okay. I had a profit target of originally of 20 pips, and I expected to get 15. But I've gone through the 15, and I'm moving really strong to the 20. So let's move out to the 25 or the 30 pip level for that profit target. It's very difficult for you to do that when you're trading a mini account because you don't have this, you don't have the background, you don't have the win to loss ratio and the average win value and the per trade expectation value. You don't have those metrics that allow you to have the flexibility in manipulating your account or a large enough account to manipulate a large enough account in order to squeeze that rock. So the only way that you have to squeeze the rock if you're a beginner trader or you're trading smaller account sizes is to simply make absolutely friggin' sure that every time you go in, that it's the absolute sniper best trade entry that you can think of, and that you're only going to make that one trade for the day. Don't sit there and try to think you're going to scalp. You don't have the skill for that. Very rarely do I scalp. And do you want to be scalping with a 10-lot trade? I don't think so. If you're a scalper, the advice is trade small and trade a lot. So if I had a six-figure account, say at $100,000, I wouldn't trade a $100,000 account scalping. I would trade a $100,000 account scalping if I had a $500,000 or $1 million account. But trading a $100,000 account scalping, I'd trade maybe 30,000 of that, three fulls. But we're kind of getting off the track here. In squeezing the account the way you would normally do that, day trading or even in the longer term trades, although I don't suggest that because you just leave too much to chance and there's too much planning that goes involved in looking for a 200 pip profit target. In any event, if you don't have your trade entry right, guys, it doesn't matter whether you're shooting for a 200 pip profit target or a 20 pip profit target. If you don't have that entry analysis down, you're never going to get the plane off the ground. You're not. You're going to crash every time. So the advice is to get the trade entry analysis down so good that the price doesn't move against you right away, but that it moves in your favor 5 pips, 6 pips. Bring your stop up to break even and walk away and see if it gets to the profit target because you have nothing to lose. If it fails and you have this short stop, it breaks even. Well, good. It didn't cost you anything to play the game. There's a lot of people that say, well, you got to give price room to breathe. Give it a 20 pip loss point. Give it a 10 pip loss point. Why? If it moves a little bit in your favor and then it goes against you, do you think it's only going to go against you 3-4 pips? The probability is it'll go against you 10 pips. So don't take that chance. Why take that chance? Lock the profit. When the price gets to 5 pips, if it's moving, it isn't going to come back 5 pips right away. It'll go another 3 or 4. And then you can bring that stop up from break even to 3 pips. And if you're carrying a 10-lot trade, that's $300. If you're carrying a 1 mini, it's $3. It doesn't make any difference. It's 3 pips. And if you can consistently get 3 pips, I just did the math for you. Now, to do that might require you trading every day. I don't personally like to trade every day. I like to get up, look at the chart, look at the real estate. There's no trade there. Go get a cup of coffee, do a YouTube video. I'm not going to trade. I mean, I have a lot of volatility right now in that trade. I made $5,500. I could go back in there now and probably make another $300 or $400. Why? Why bother? talk to you guys. And so squeezing the Forex rock at the lower bank levels, and look, five-figure account is not a low bank, and for some of you, trading $2,000 is an enormous amount of money. It's all the money in the world. I appreciate that. Don't think in terms of the money. Think in terms of the pips. Make 2 pips a day. Make 1 pip a day. You make 1 pip a day, average. In other words, you may lose, but average 1 pip a day, 5 days a week. That's 5 pips a week. 5 pips a week. 20 pips a month. That's 2% on your $1,000 bank. Don't worry about the money. Worry about the pips. Make 1 pip a day. When you can consistently make 1 pip a day, go to 2 pips. Go to 3. Be happy at 3. Get comfortable with 3. Because it's very difficult to get that 5 unless you really hone your skill down. 5 pips is a lot. Look, on a 5-period ATR, on a 5-minute chart, blah, on a lot of the majors, the ATR is 5. So price goes from wherever you are, and it goes up 5 pips. It's gone an ATR. Okay? So you might have a 2 or 3 pip retracement. And you might have another 3 or 4 pip retracement. Because if that 5 pip rise is tagged on to 3 other 5 pip rises to convince you that it was moving in the right direction, you've got 3 5 pip rises, you've got a 15 pip run that you're just starting to get at the end of. Why wouldn't you have a 7 or 8 pip retracement? Okay? You've got to learn your trade entry well. That's how you squeeze the Forex rock for more money. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.